Singapore banks have been hit by the double whammy of low interest rates and weak growth. The big three, DBS, OCBC and UOB, all reported profit declines of between 22 and 40% in the second quarter. The results were largely in line with analysts' expectations.
We saw net interest margins coming off quite sharply across all three banks. We saw fee income coming off. We saw provisioning increasing quite significantly across all three banks. An area I think that surprised was loan growth, where it actually came in a little bit better than what we were expecting, partly showing the strength of the regional franchises that these banks have.
Asset quality was stable during the quarter, but could weaken as loan moratoriums expire. Uncertainty over how the COVID-19 situation will evolve is another headwind Singapore banks face.
We are still very much in the early stages of this crisis. A lot of the lending loans are still on moratoriums. So as we go into the second half, we'll start to see some of these moratoriums get lifted, and we'll start to see the real impact on the economy and the real impact to cash flows and business models.
The moratorium scheme in Malaysia will be the first to expire. For Singapore, the moratorium started in April and it will end at the end of December this year. So we will be looking out for repayment trends, and with that, we can better shape how we think about impairments going forward.
Singapore has entered its worst recession since independence. For the second quarter, the economy shrank by 13.2% on year. That's its worst ever quarterly contraction. The city-state also downgraded its economic forecast for 2020 to a contraction of between 5 and 7%. According to Moody's, non-performing loans ratios at the three banks was between 1.5% and 1.6% at the end of June. Those figures are likely to double to over 3% in 2021. The majority of new NPLs will likely be from corporates in sectors that have been hurt by disruptions from the coronavirus outbreak.
Banks typically have exposure to large corporates. DBS is a bit more exposed to large corporates. So if you're a corporate in a vulnerable industry these days, I mean, we're talking airlines, we're talking transportation, tourism, so then you might see more issues. We're also seeing credit problems in the SME books of the Singaporean banks, and here UOB will be more exposed to the SME books, to the SME clients.
To cope with any defaults that could emerge as the moratoriums unwind over the next few months, the trio have beefed up provisions.
The bad loans have not changed much in the second quarter, but what the banks have been doing in the second quarter as well as in the first quarter, they're building provisions ahead of potential problems.
I think as we go into the second half, we'll start to see more specific provisioning coming through, which is actually aimed at specific NPLs, because nobody knows the size of the overall NPLs that can come through.
In a preemptive move to bolster the bank's resilience and ability to support lending, the Monetary Authority of Singapore called on local banks to cap their total dividends per share, or DPS, for financial year 2020 at 60% of 2019's level.
So dividend cap is a pretty positive development for the Singaporean banks. They basically conserve more capital, and ultimately it's a good thing for the creditors of the Singaporean banks. There's more capital available to the bank to offset maybe unexpected losses. But even without the cap, we don't think the Singapore banks would have been aggressive in terms of their dividend policies.
The move did, however, catch some investors off guard.
The dividend cap did come in as a bit of a surprise. Now, whether investors are happy about it, we did see bank stocks did come off. quite notably, but it has kind of settled since then. I think the expectation of 6% sort of dividend yields from the banks have now been recalibrated down to about 4% sort of dividend yields.
Bank share prices have come down year to date over 20% now, and this was contributed by a few factors. You had the Fed rate cuts earlier in March, you had the volatile oil prices, and more recently you also had the MAS cut on dividends. So that we have seen the incremental impact on those events, as well as the bank's call for credit costs to be significantly higher than of previous years. So that, I think, has been priced into the share prices.
While investors grapple with asset quality risks and dividend payout caps, there are also some tailwinds to look forward to.
I think the upsides we can look forward to is if borders reopen tomorrow and capex plans can resume, there won't be delays in my shipment, and my factories will have the demand that we used to see pre-COVID. So the faster the recovery comes in, that's the upside that we're looking for the banks. With Singapore being such a mature industry, I think there certainly is upside in Singapore moving towards the whole green and ESG stream, where I think it's increasingly become a focus area of investors.
The economic landscape of ASEAN is being reshaped. You're having supply chains moving from the North Asia to Southeast Asia. You're starting to see a much more greening of finance with a lot more sustainability-linked loans and green bonds and so on being issued. You're starting to see a lot more technology being brought into finance. So I think for a lot of these trends that will take place over the medium term, the Singapore banks are very well positioned to benefit from them.